बिस्मिल्लाहिर्रहमानिर्रहीम। आज का टॉपिक है वोलेटिलिटी इन फाइनेंशियल टाइम सीरीज। Volatility represents the magnitude of price fluctuations in financial asset. Magnitude of price fluctuations यानी गौर करें तो magnitude of price in a financial asset. High volatility indicates larger price swings, while low volatility suggests more stable price movements. Volatility is commonly measured using statistical metrics such as standard deviation, variance, or more complex measures like ATR, average true range, or the standard deviation of logarithmic returns, log returns. Volatility modeling. Various models like GARCH, generalized autoregressive conditional heteroscedasticity, and ARCH, autoregressive conditional heteroscedasticity, are used to model and forecast volatility in financial time series. आर्च गार्च हैं जो मॉडल के लिए यूज होते हैं टू मेजर द वोलेटिलिटी मॉडल। व्हाट इज अगर हम क्वेश्चन वाइज इसको डील करें, व्हाट इज वोलेटिलिटी क्लस्टरिंग इन फाइनेंशियल टाइम सीरीज? Volatility clustering in financial time series refers to periods of wide price swings, okay, followed by relatively calm period. एक calm period से अगर wide price swing आ जाए तो उसको कहते हैं clustering, volatility clustering. These series such as stock price or exchange rates tend to show large positive and negative observations occurring in clusters due to impact of news and external economic events. What is knowledge of volatility important in various areas? Understanding volatility in crucial in macroeconomic, macroeconometric, macroeconometric studies, financial planning, decision making. Variability in inflation rates, exchange rates, and stock price poses challenges for planners, traders, and investors, impacting financial planning, profits, and market stability. Why is modeling volatility essential in a financial time series? Why modeling is necessary? Financial time series often exhibiting non-stationary behavior in their level form can be modeled effectively in their first difference form. Modeling in first differences helps address the non-stationarity, but these differences often display wide swings or volatility. वाइड स्विंग जो है उसको वोलेटिलिटी कहा जाता है, वाइड स्विंग्स. Modeling varying variance is crucial, leading to application of the autoregressive conditional autoregressive conditional heteroscedasticity ARCH model developed by uh, How are financial time series typically modeled to account for validity, for volatility? Financial time series like stock prices, exchange rates, and inflation rates, commonly characterized by non-stationary random walks in their level forms, are modeled differently. Instead of modeling their levels, analysis often focus on modeling their first differences, which tend to be stationary. However, these differences exhibit volatility nece- uh, necessi- necessitating the use of models like the autoregressive conditional heteroscedasticity arch model to capture a varying variance over time. What are implications of volatility in financial time series for different market participants? Importers, exporters, traders in foreign exchange markets, and investors in the stock markets are affected differently by volatility. Volatility in exchange rates can lead to significant losses or profits for importers and exporters, while stock market investors face greater uncertainty and potential gain or losses due to high volatility. How does news and economic events impact volatility in financial time series? How does news and economic events impact? Financial time series such as stock prices and exchange rates are influenced by news and external economic events. News can lead to various in, interpretation among market participants, causing large positive or negative swings in these series, resulting in clusters of volatility. Why is modeling varying variance important? Varying variance important in financial time series. Modeling varying variance important in financial time series. Modeling varying variance, which refers to the changing variance or volatility in financial time series, is crucial for accurate modeling. Crucial for accurate modeling. Financial time series in their first difference form often exhibit wide swings or volatility, necessitating models like the autoregressive conditional heteroscedasticity model to capture and predict varying levels of volatility over time. What challenges does volatility pose for companies operating in volatile markets? In highly volatile markets, companies face difficulties raising capital in capital markets. The uncertainty and wide price swings in such market make it challenging for business to secure funding or investments necessary for growth and operations. Arch, autoregressive conditional heteroscedasticity, and GARCH, generalized autoregressive conditional heteroscedasticity models, are statistical tools. These are the tools, statistical tools used to model and analyze time series, particularly in finance, to capture and predict varying level of volatility or variance. इन केसेस में ये दो मॉडल हैं जो इनको यूज किए जाते हैं। ये टूल्स हैं जो हमें ये बताते हैं कि टाइम सीरीज डाटा के अंदर वॉलेटिलिटी फैक्टर मौजूद है। पर्पस आर्च मॉडल पर्पस developed by Robert Angel, the ARCH model focuses on volatility, capturing time varying volatility in financial time series. Capture concept, it assumes that the variance of the current observations depends on past scared residuals or shocks, suggesting that periods of high volatility are followed by more volatile periods. Equation arch model में is represented by variance of yt given uh, omega t minus 1 alpha naught plus summation I is from 1 to p alpha I epsilon t minus I square. Residuals, scared residuals, where et minus I squares represents the scared residuals from previous periods, t minus I from previous periods, and alphas are parameters to be estimated. Application arch models are used to capture volatility clustering in financial time series, especially in stock returns or asset prices. Application arch models are used to capture volatility clustering. The same paragraph. GARCH model, generalized GARCH, extension of Arch. GARCH, an extension of the Arch model, was proposed by Tim Ball-Slev to address some limitations of the Arch model concept. The GARCH model not only considers past scared residuals, not only uh, considers the past scared residuals, but also includes lagged conditional variances in the equation, allowing for more sophisticated representations of time varying volatility. GARCH PQ model is represented by variance yt given omega t minus 1 alpha naught plus I is from 1 to p alpha is epsilon t minus I squares plus this term. J is from 1 to q beta j variance of yt minus 1 uh, lagged conditional variances. This is the lagged conditional variances given omega t minus j minus 1, where epsilon t minus squares represents scared residual, alphas are arch parameters, and betas are GARCH parameters. Application GARCH models are widely used in finance to forecast volatility in asset prices, manage risk, price opinion options, and derivatives by providing more accurate volatility estimates compared to simple historical or constant volatility measures. Both Arch and GARCH models are essential tools. You know, these are two essential tools in financial econometrics and time series analysis. In both financial uh, financial econometrics and time series analysis, they help analysts and investors understand and predict volatility patterns in financial markets. Analysts and investors, they help to understand uh, and predict volatility patterns in financial market, allowing for more informed decision making and risk management strategies in investment and portfolio management. Here are examples: US versus UK exchange rate. An example, figure 22.6 gives logs of monthly US week UK exchange rate dollars per pound for the period of 1973 and to 1995 for a total of 276 monthly observations. 22.6. This figure, here's a figure of this one. So in this figure there is a lot of fluctuations, volatility in in, in this data. Okay, as you can see this from this figure, there are considerable ups and downs in the exchange rate over the sample period. To see this more vividly in figure 22.7, we plot the changes in logs of the exchange rate. इनका log ले लिए logs y axis पर. Note that changes in log of variables denote relative changes, which it multiplied by 100 give percentage changes. As you can observe, the relative changes in the US UK exchange rates show periods of wide swings for some time periods and periods of the rather moderate swings in other time periods, thus exemplifying the phenomena of volatility clustering. Now, practical question is how do we statistically measure volatility? Let's illustrate this with our exchange rate example. Here's a figure of 22.6 and 2.7, taking the change in log exchange rate, right? Uh, Now the practical question is how do we statistically measure volatility? Let's illustrate this with our exchange rate example. YT stands for US versus UK exchange rate. YT steric log of YT and difference of YT steric steric minus t minus 1 steric relative change in the exchange rate, and mean of the exchange rate xt is difference of the mean of dy y steric. Accepting xt square as a measure of volatility, this one, how uh, do we know if it changes over time? Suppose we consider the following AR or ARIMA model. Xt square equals to beta naught plus beta 1 xt minus 1 square plus ut. This model postulates the volatility in the current period is related to its value in the previous period plus a white noise error term. This white noise error term. And beta 2 is positive if it suggests that if volatility was high in the previous period, it will continue to be high in the current period, indicating volatility clustering. If beta 1 is 0, okay, if beta 1 is 0, it will continue to be high in the current period, indicating volatility clustering. Sorry, if beta 1 is 0, then there is no volatility clustering. Okay, if beta 1 is 0 here, then no volatility clustering. The statistical significance of the estimated beta 2 can be judged by utility test. There is nothing to prevent us from considering an AR model of volatility such that P lag AR xt square beta r plus beta 1 xt minus 1 square plus beta 2 xt minus 2 square and so on. Beta p xt minus p square plus ut. This model suggests that volatility in the current periods is related to volatility in the past p period, the value of p being an empirical question. This empirical question can be resolved by one or more of the model selecting criteria that we discussed in chapter 13. For example, cake information measure. We can test the significance of any individual's beta coefficients by the t-test and the collective significance of two or more coefficients by the usual f-test. Model is an example of ARCH 10.1. This is a model of ARCH model. ARCH 1 having the is called yes, this one, the second model is ARCH of P model, and P represents the number of the autoregressive terms in the model. Before proceeding further, let's illustrate the ARCH model with US-UK exchange rate data. The results of the ARCH 1 leg 1 model were as follows. Let's the model of ARCH model is fitted model is this here. Okay, since the coefficient of lag term is highly significant, p-value is about 0.005, it seems volatility clustering is present in the present instance. We tried higher order ARCH models, but only the AR of one model turned out to be significant. How would we test the ARCH effect in the regression models in general that is based on time series data? To be more specific, let's consider the k-variable linear regression model and assumes a conditional on the information available at time t minus 1. The disturbance term is distributed as the disturbance term is distributed as normally with mean 0 and variance alpha naught plus alpha 1 ut minus 1 square. That is, the ut is normally distributed with mean 0 and this variance. That is, the variance of ut follows an arch process. The normality of ut is not new to us. What is new is that the variance of u at this time t is dependent at time t is dependent on the scared disturbance at time t minus 1, thus giving appearance of the serial correlation. Of course, the error variance may depend only on one lagged term of the scared error terms, but also on several lagged scare terms as follows. Not only the one lag term but also the p lag terms are here. So arch of p model is this one, having a variance of this one. Variance of ut is equals to this with lag p. If there is no autocorrelation in the return, then these all alphas will be 0. Okay, in which case of variance ut is alpha naught, and which is sigma square, and do not have the arch effect. Since we do not directly observe sigma t square, Angel has shown that running the following regression can easily test the preceding null hypothesis. Ut square equals to this term is usually denote the OLS variance obtained from the original regression model. One can test the null hypothesis H0 by the usual F test, alternatively by computing an R square, where R square is coefficient of determination from the auxiliary regression. It can be shown that n R square distributed chi-square of lag p is that the large samples and R square follows the chi-square distribution with degrees of freedom equal to the number of autoregressive terms in the auxiliary regression. This auxiliary regression. Before we proceed to illustrate, make sure that you do not confuse autoregression of the error terms as discussed in chapter 12 and arch models. The arch model, it is the conditional variance of ut that depends on the scared previous error terms, thus giving the impression of the autocorrelation. Okay, variance of the in arch model, the variance of disturbance term. Another example, New York Stock Exchange price changes. As a further illustration of the arch effect, figure 22.8 represents monthly percentage change in the New York Stock Exchange index for the period 1952 to 1995. It is evident from this graph that the percent price changes in the New York Stock Exchange index exhibit considerably volatility. Notice especially the wide swing around the 1987 crash in stock prices. A wide swing in 1987. Here is the widely swing in this figure. To capture the volatility in the stock returns seen in the figure, let's consider the very simple model, this one, yt equals to beta 1 plus ut, where yt percent change in the New York Stock Exchange stock index and ut is the random error term. Notice that besides the intercept, there is no other explanatory variables in this model. From the data, we obtained the following OLS regression. If we fit this line is yt hat equals to 0.00686, then t value 3.8835, which shows that this parameter is significant. What does this intercept denote? It is simply the average percent rate of return on the New York Stock Exchange Index, or the mean value of yt. Can you verify this? Thus, over the sample period, the average monthly return on the New York Stock Exchange Index was about this figure, 0.00686%. Now we obtain the residuals from the preceding regressions and estimate Arch1 model, which gave the following results. UT square is fitted with the UT minus 1 scare terms, and having the t value is 8.89 and 2.69, which shows that both are the both terms, both parameters, both alphas are significant, where UT hat is the estimated residual from regression 12. Since a lagged scared disturbance term is statistically significant as p-value about 0.007, it seems that variances are correlated. Okay, that is, there is an arch effect. This effect is called as arch effect. We tried higher arch or higher order arch models, but only arch one was statistically significant here. As a further illustration on the arch effect, figure 22.8 presents monthly percentage change in the New York Stock Exchange index for the period of 52 to 95. It is evident from this graph that percent price changes in the New York Stock Exchange index exhibit considerably volatility. Notice uh, especially the wide swing around 87, crash in stock prices. You can see this figure uh, around 87. This is this crash effect, crash in stock exchange, and kept yes. Notice especially wide swing around 1987, crash in stock prices. To capture the volatility in stock returns seen in the figure, let's consider a very simple model. Yt equals to beta 1 ut. Ut is percent change in NYSE stock index, and ut is random error term. Notice that besides the intercept, there is no other explanatory variables in the model. From the data, we obtained the following OLS regression. A word on Durbin-Watson D and Arch effect. We have reminded that reader several times the significant D statistic may not always mean that there is significant autocorrelation in the data at hand. Very often a significant D value is an indication of model specification errors that we discussed in chapter 13. Now we have an additional specification errors that due to the arch effect. Therefore, in time series regression, if the significant D value is obtained, we should test for the arch effect before accepting the D statistic as its face value. An example is given in exercise 22.23. A note on the GARCH model. Since its discovery in 1982, arch modeling was become a growth industry with all kinds of variations on the original model. One that has become popular is the generalized autoregressive conditional heteroscedasticity model, originally proposed by Bullerslev. The simplest GARCH model is this of 1-1 model, GARCH 1-1, which can be written as with the arch parameters and with the GARCH parameters. Sigma t square is variance of alpha naught plus alpha 1 ut minus 1 square plus alpha 2 sigma t minus 2 square. Arch effect and GARCH in variance terms. So this is all for the arch and GARCH model here. Okay, so that's all for up till this, and next lecture will be on the exercise of uh, these two models, Arch and Gorge. Okay, take care. Allah Hafiz.